This is Bible School Radio. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, is the war over? Why you should be careful. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know, I do appreciate it. Listen, if you got a question for me, I'd love for you to, or invite you to go to the website, www.prudentmoney.com. There is a section at the very top of the page where a link that you can click through, go to where it says Ask Prudent Money. We'll get you all taken care of. That's off the website, www.prudentmoney.com. Well, it was a wild day on Wall Street. Of course, that's what happens when you're in these volatile type environments. Now, volatility is something that is a hallmark of the market changing directions. And obviously, before all this this war with Iran came about, we were, well, let's go back even further than that. Up until maybe December or so, the market had been going up, and then it went kind of on a sideways direction, and then it's been coming down. So President Trump today signaled that the war in Iran was, and I quote, complete. I don't know what that means. But I do know that that is how he is able to control the market. It's kind of whatever he speaks into existence happens. So I would encourage you to make sure that you can see if you got money that is sitting in assets that aren't as risky or maybe sitting in cash, that you make the market prove it a little bit to you before you start putting that hard-earned money into investment accounts. You know, it's just because it's one of those things where just this morning he was talking about ground troops. And so how do you go from ground troops to not needing ground troops? I don't know. I just kind of think that's what the way that he does things. A barrel of oil was up as high as about $120 a barrel. Thankfully, it did close a lot lower. And the problem is that the Straits of Hormuz, this waterway, which is the I think it's 20% of the global oil goes through that on tankers, and that's that's been the problem, is they've shut that down. Well, by shutting that down, it has created a historic situation, and I haven't seen anything as from an oil shock like we've seen in that waterway. So once again, I don't know how it's possible for the war to be complete based on what he's saying today, based on what he said the last week. And so I would just be real careful with that and make sure that you got to look at it this way too, is that they announced a new supreme leader in Iran. So this would mean that there's no problems there. I mean, he was as radical, or he is, as from what I understand, he is as radical as his dad was. And he's just going to give in to the U.S., their most hated enemy, and going to start his reign. I just, excuse me for being, or having my doubts, but I just really have my doubts that's going to just be that all it is, all the problem it is, and be gone. So just and then there was the idea, or the direct command, we'll say, that President Trump's had that everybody was going to have to lay their arms down and surrender. Yeah, I can't imagine that happening either. We're talking about a war that really started about 47 years ago, according to financial media. And I guess we're probably their most hated enemy. Who knows? But I just can't imagine that. Once again, it's just gonna go away and everything's gonna be fine. Looking forward to getting back to that time, but there's also the question of how long do oil prices stay elevated? That is also a problem. That's a problem. So we'll have to see how it plans out. Pans out. But having said all that, once again, make the markets prove it. I think that's very, very important. Let's talk a little bit about correlated versus uncorrelated investments. I wanted to say this to be able to talk about this today because one of the best strategies overall to use when investing money, and an effective way to use to invest money, is the method of diversification. But yet there are some problems and some misunderstandings with diversification. The true definition of diversification is to take your money and spread it over, let's say, 4 categories of investments. I didn't say types, and this is one of the things you got to be real careful about, that you understand the difference between categories and types. I had someone come into my office. This was many, many, many years ago. And I'd asked him about his 401k portfolio, and he said, glad you asked. Let me show you how I have it invested. And so he said, just like you always teach, it's perfectly diversified. And so he had it spread over, 15 different mutual funds. And so I said, the problem that you have is that you're dealing with correlated investments. You could have 10, 15 different types of stock funds, but it's all going to go under the category of stock. And stocks tend to be, most of the time, correlated, meaning they move in the same direction. See, the whole basic definition of correlated versus uncorrelated is that correlated investments move the same direction, and uncorrelated investments move in different directions. So it comes down to this. If you're going to diversify a portfolio, and it's very, I think, one of the most important things you can do. I mean, that's how you control risk. That's how you balance things out. And it's a very important concept. But one of the problems that you have with what people think are non-correlated investments, meaning you have some that come up, some that go down. You have a mixture of bonds that are supposed to do the opposite of what stocks do, but we really haven't seen that much. And I also make a note here to go back and talk a little bit about interest rates. Just realized I forgot about that. So you rarely have investors have a good bit in non-correlated. And non-correlated is very, very important because with a true non-correlated investment, we can balance out the risk and really spread it out over the different categories of investments. It's a very important concept. One of the things you run into is, in the last 15, 20 years or so, you haven't run into the problem of not having choices, but you run into the problem of having choices of investments that are not truly non-correlated. So if you had an investment that went down 20%, let's say, well, that non-correlated investment might have only gone down 15%. That's still pretty close to the 20% that the first one went down. So you got to be careful with that, because not all non-correlated investments are true to their category. But watch the category. 'Cause I think the category is very important. You know, one of the things that I've put together and monitored is a mixture of stocks and being the kind of the minority in the portfolio, and a big mixture of short-term bond funds. And that is something that it doesn't gain a lot, but it's something for somebody who's very, very risk adverse. It gives them something that they can really invest into, and it worked out pretty well. But the good thing about taking true non-correlated investments and then correlated investments is that you can adjust the risk of each investment, of what's acceptable and what's not acceptable, and you can invest whatever percentage that you want to in those particular investments, which gives you this very diversified, perfectly, well, I don't say perfectly, I might get in trouble saying perfectly, a diversified balance of risk in your portfolio. Another problem you run into is that you're very limited as to what you have available in your 401k plan. So we'll talk about that. This is Bob Brooks. We're up against the break. Stick around. I'll be right back. Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
Hi, I'm Pastor Mike Fabarez, Bible teacher on Focal Point, and I'm hosting a live 1-hour call-in show to answer your questions about the Bible, about comparative religion, about faith, whatever it is on the radio, whether you're wrestling about doctrinal complexities or seeking some kind of guidance on your life's challenges. I want to hear what's on your mind. For more details, go to focalpointradio.org/live and join us Tuesdays through Thursdays at 1 p.m. right here on Bible School Radio KDKR.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. If you got a question for me, go to the website, www.prudentmoney.com, and go to the top of the page. There is a link that says Ask Prudent Money. Just send your question in. We'll get you taken care of. Also, sign up for the Prudent Money email list, and we'll also keep you posted with what we post on the website. It's off the website, www.prudentmoney.com. So I want to talk a little bit about interest rates, because I think that is one of the markets, or let me say the one aspect of the bond market, let me say, that we want to really keep an eye on. And today, let me say this, is that if you're invested in bonds and this thing is over with, I think that you would see a great deal of money flow into the bond market, which is a net positive. Instead, the market stayed a little bit down, interest rates a little bit up, and didn't do much of anything. So which tells me that the interest rate markets are not buying into this. They're still forecasting inflation. I believe if that were true, we would see a different outcome in the marketplace. So I wanted to say that about interest rates because I did promise I would keep up with that for you. The other thing that I want to remind you of as you kind of work your list, and I encourage investors to have lists of investments they want to watch, investments they would like to add to their portfolio, whatever it may be, so you can keep up with that. Of course, with the technology we have today, it's very easy to do. But keep a look at risk. I would definitely have the 10-year yield on the 10-year Treasury bond as something that I watch. That's where we get the interest rate from. And if you ever want to know, if you say, Bob, I can't find this, I don't know where to look, shoot me an email and I'll tell you where you can look. But don't forget about the really the one big thing that still awaits us of trying to figure out. And of course, the war in Iran is taking center stage, and you haven't seen much about it. But that is the tariffs. 2 weeks ago, that's exactly what we were talking about. That was the issue, and of course, the war took the attention off of that issue, and we have what we have. Bottom line, though, is two things. Will these countries under this 15% global tariff pass that on to consumers at cost? Remember, if a widget cost $10 before the tariffs, now it costs $10 or $11.50. Probably, more than likely, the country that got the tariff slapped on them is going to pass that on to the consumer. So the consumer is going to have to pay $11.50 instead of the $10. Hope that makes sense. And so we still have that to deal with. And then the question of, is there stagflation or not? And I wonder how much what President Trump had when he came out and talked about the war being complete, how much that really has to deal with the the Federal Reserve Board meeting next week, because big decision for Federal Reserve Chairman Powell and his board of 12 governors in trying to determine should they raise or lower interest rates. Yes, I did say raise, because you would think that there's no way they would want to raise interest rates. But with inflation building like it is, and I think the next inflation number when they release it, which will still be, I'm not really sure what day that comes out on. Let's not say that. But anyway, still to come for March. I think it's going to be fairly high. But what to do? Because if you have inflation like that, you raise the interest rates. If you have recession, like I think we're heading towards, you lower the interest rates. But if you lower the interest rates, that feeds the inflation, so forth and so on. It's a job I would not want to have, and tough to know exactly what to do. So that is coming your way next week. So let's talk a little bit about, we talked a little bit about just a couple of days ago about gold not acting like a quote-unquote safe haven investment. I still want you to keep that on your radar. for those that want to buy gold for that reason. I just don't think that that's a good reason to buy it for. I think that comes down to it's a good investment that is somewhat non-correlated to the market, but there's still a strong enough correlation that you might want to think twice, because safe haven, once again, is not the word I would use. And let's see. Seeing short-term money markets, where those are going to go, that's something that a lot of people have missed out on because they haven't known about the fact that you can actually take your money market investments, put them in something that's made as high as 5%. And we're talking money markets, and this isn't a advertisement or marketing to promote either one of these companies, but you're seeing your big money market funds at a Fidelity, at a Vanguard, and that type of thing. And now they, of course, have gone down in price, or the interest rate has gone down, and so. But that could be going back up as well. I'll have to check on that, and I will let you know about that. The other thing, as we get into our final time together, actually, let me come back to that. I've had a question that came out that someone asked about, how do you know if you're in a bear market or not? You know, how do you really assess where we are in the market cycle? And I've talked about the market cycle in many, many different times, and it really talks about where we are long term. If I had to guess, my forecast would be, and a forecast is pretty much just a guess, but my forecast would be that we are coming down to the end of a bull market, which is a great market to be in, and coming into a bear market. But what you're really wanting to focus on is one of three different declines. First would be a correction. That's when the market declines over 20% and then rebounds and comes back and heads back into a bull market. That is what Wall Street, CNBC would definitely want you to believe this happened here. It's a correction. And this is not an easy one to get right. So you always got to be a little bit careful when it comes down to the guesses. Then there's a market crash. And I personally don't think that a market crash is so bad. If I had to choose out of those three, I'd probably pick the correction. But a stock market crash like the one in 1987, which is the second biggest one on record, that one, the good thing about a stock market crash is that it's short-lived, and typically it rebounds back. So there's a limitation as to how far it goes down, and kind of goes back and forth a little bit and comes back into the bear market. But it gets obviously a lot of negative press. Then there is the bear market, and this is what I think that you've always got to be real careful of, and want to make sure that you're not heavily, this isn't a recommendation, but that you're watching what you're investing into if it is a bear market. We haven't seen one in a long time. I could make a case for it. I got to tell you, I don't really know, obviously, if it is or not. We need to see so much more. But those are the three different types of declines we could be looking at. Now, the question comes up as we wrap it up: are bond funds a good buy as of yet? And it's a very simple equation to look at. If interest rates are going up, just in general, that means that bond prices are going down. If interest rates are going up, that means bond prices are going down. Bond prices have been going down for a long time. It's because interest rates have gone up. So I seriously doubt that. I think it all is clear. Could you potentially find some good bonds? Maybe. But once again, I think there's a lot of landmines out there you want to be careful about. Hey, this is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com. And until we do meet again next time, because keep up the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.